An easing of trimmed mean inflation figures in the latest monthly CPI data drop has raised hopes of the RBA beginning its rate cutting cycle from February. But with inflation still above the RBA's target band, is it enough? And is it falling fast enough for the RBA to be satisfied that now is the time? Joining me live is Moomoo Chief Commercial Officer Michael McCarthy. Michael, it's good to see you. So we had that mean trimmed inflation figure. It looked like the RBA, looked at more by the RBA, that figure. It did ease slightly. Treasurer Jim Chalmers claimed it's another win in the fight against inflation. Was it, in your opinion?
Well, we can't dispute that core inflation measure, the key measure, fell from 3.5 to 3.2% and is heading into the band, it seems, of 2 to 3% that the RBA prefers. It's good news in that respect, but we're nowhere near where we need to be, and we really need to see much more action on fighting inflation and getting it sustainably down into that band. There seems to be a lot of thought around the idea that 2.9% would equal an RBA rate cut, particularly if we saw that figure in the quarterly data due at the end of this month. But the reality is there's no pressure on the RBA economically to cut rates. Their mandate revolves around prices and unemployment remains nearer historic lows and what economists might call full employment than anywhere near an area of concern. And with unemployment in such a benign situation, there's no economic pressure on the RBA. Having said that, there are a lot of beneficiaries from a rate cut, whether you're a mortgage holder or a leveraged corporate or a government seeking re-election. So there's a lot of social and political pressure, but I think the RBA board and the governor have been signalling very clearly with their use of that word sustainably below the target rate that they're not in a hurry to cut. And I don't think we'll see an interest rate cut in Australia before the second half of this year.
Yeah, right, because the consensus generally was May was the earliest it would be seeing a rate cut. But after that data drop yesterday, market traders are now pricing in a 75% chance of a quarter point reduction in February. So has this changed the timeline at all?
Well, certainly not according to the interest rate traders, but I'll point out they've been wrong for at least 12 months. They were anticipating cuts as early as February last year, and of course, as we all now know, there were no cuts. So the fact that market pricing is leaning that way might reflect the kind of books that the bond traders are running rather than a real assessment that there's a rate cut coming. In other words, their books are awash with liquidity at the moment, and that means they're looking to invest, but they don't want to get caught in a situation because at the long end of the curve, we're seeing rising interest rates, and holding bonds while long interest rates are rising is a very costly business. So they're concentrated at the short end. And while that pricing does reflect that probability, it might also reflect the fact that at the moment there's a lot of money sloshing around the Australian monetary system.
We got the unemployment rate coming out next week. What are you expecting there?
Absolutely crucial read on this one. If we do see it trending upward, it certainly makes a much stronger case. We've moved up from those historic lows around 3.5% last year, currently sitting around 4.2%. If we were to see a move towards, say, 4.5%, that might be a signal that the RBA will get off its hands. But in the absence of a strong surge upward, I don't think we'll see any change in the rhetoric from the RBA in its meeting in February. So it is a very important read. However, at this stage, the early indications and the indications we got from the CPI data is that we're much more likely to see a very modest uptick or even a flat read. And if that's the case, there's no further pressure to cut rates.
OK, Michael McCarthy, appreciate your analysis this morning. Thank you.